markets may also be minding earnings more than the Fed's minutes, with indices struggling to keep momentum as this earnings season comes to a close. But the year may still end on a positive note. Joining us with why is Sam Stovall, CFRA Research Chief Investment Strategist. Good to see you, Sam. So I want to get some of your projections. I mean, does it seem like markets are now finally on the same page as the Fed?
Well, I think, yes, they are on the same page because the Fed has been very consistent with its message of higher for longer. But I think the reason that the market is green today, or at least slightly so, is because the minutes did not come out very hawkish rather than just hawkish, as your Chiron was on the bottom questioning that just a few minutes ago. So I think investors are assuming that the Fed will probably raise rates maybe 3 more times, 25 basis points each in March, in May, and in June, hit the pause button. And then the real question is, when are they likely to start cutting rates when they normally do so about 9 months after the last rate hike?
And I want to ask you about your expectations for March. We've seen a couple of, dire projections coming up. Morgan Stanley's Mike Wilson compared the 2023 rally to climbers scaling Mount Everest without considering the risks. We saw from Bank of America's Michael Hartnett saying that the S&P's gains so far this year could be wiped out in March. What are your expectations for the coming month?
Well, I think that the market is grudgingly going to be working its way higher. I think the first half of this year, because of the uncertainty associated with for how long will the Fed be raising rates, I think that's going to add to the volatility in the first half. But once the Fed does end up hitting the pause button, then I think investors are going to be looking across the valley. Of course, the big question is, how long will that valley be? And is it simply a mirage that they are looking at? But our belief is that the Fed will likely start to cut interest rates in the early part of 2024. We have seen traditionally that the market actually does fairly well the year after a down year. We've only had 2 times since World War II that we had more than 1 down year in a row. So the probabilities would indicate that we're probably likely to see an improvement in the results in 2023 versus 2022, that we're likely to see a rotation from first to worst, meaning going from the defensive sectors of consumer staples, healthcare, and utilities, which held up the best last year, to those groups that were beaten up the most last year because they have the greatest upside potential.
And as we try and look at history, I mean, usually the third year of a presidency is supposed to be very good for the S&P, but this doesn't feel like it's been a typical kind of year. I mean, we have the Fed still raising rates with a tight labor market still in place as well. So when you think about it, and especially some of the caution that we saw in the earnings outlook, what should we be mindful of when we sort of try and look back at some of these historical projections and some of the differences that we might see this year?
Well, I think you're absolutely right that history is a great guide. It's never gospel, but it does give you an idea of what is likely to happen. And you look to probabilities to see whether that will come true. Third year of a president's term in office is by far the best, gaining an average of 16% and rising in price 84% of the time. And also from October 31 of the midterm election year through October 31 of the third year, the market has never fallen. Actually, it has posted an average total return of 21% since World War II. So, not a guarantee, obviously, but it does offer encouragement that we at least could keep our head above water in 2023. But every year is a little bit different. What's going to happen in terms of the depth of the recession, which I believe we are going to be falling into, but our belief is it's likely to be mild. What about an earnings recession? Will that last into the second quarter as we currently anticipate? And then what about geopolitical actions, et cetera, that would be almost impossible to try to forecast at this point. So there are a lot of uncertainties out there. So investors probably don't want to be backing up the truck and buying mindlessly, but rather continue to focus on high quality stocks that do offer a nice dividend and have a consistent track record of paying those dividends.
So, Sam, with so many signals about the economy and about what the Fed might do from here, how are you prioritizing your allocations right now?
Well, obviously, since we are more of an equity shop than anything else, our focus is on the equity markets in terms of where we see the opportunities. Because we look a year ahead, not a week or a month ahead, we are focusing more on the recovery of the cyclical areas, such as the consumer discretionary, technology, industrial areas at the expense of the more defensive consumer staples, utilities, et cetera. So for those people also who do have exposure to energy, I remind them that the energy sector is trading at a 45% discount to its long-term average PE. So there still is some upside potential in our opinion.
And so then if there are three factors that you're focusing on in making these decisions, obviously you've got priority for equities, then 30% in bonds, some foreign equities as well, and then having some cash on hand. What are three sort of guidelines or factors that you're focusing on in really making these allocations?
Well, in terms of coming up with a target price, we look to history, we look to technicals, we look to fundamentals, because while history might not repeat, and it does frequently rhyme, like the singer of the national anthem, sometimes it forgets the words. So I look to price action. Prices lead fundamentals. So for me, from a technical perspective, you have to see where the trends of rotation are likely taking place. And then lastly, obviously, because we have several hundred analysts around the globe, we are focusing on a fundamental perspective. So looking at a cap-weighted target price differential for the S&P 500 gives us an idea of where it will be a year from now. In terms of U.S. investors, they're very parochial and they've not had a great reason to invest overseas. But when we're looking at such a big differential in terms of PE ratios, relative PEs for developed equities versus the S&P, looking at relative strength, et cetera, there's an awful lot of opportunities overseas. And if we do get a continuation of a weakening of the U.S. dollar, then that will certainly benefit U.S. investors who have exposure overseas.
Certainly some opportunities to be found, even in these uncertain times. Sam Stovall there, CFRA Research Chief Investment Strategist. Thank you for joining me this morning.